It's not just an asset class, but it's an inevitability. Not because it's trendy, not because it's digital gold, but because it's a natural response to a financial system that's reaching the limits of its own design. So let's start with a simple question. So what happens when the asset that you built your entire portfolio on, your ballast, stops working? For decades, a 10-year US Treasury was the world's safest asset. It hedged against drawdowns, and it paid real yield. It helped you meet your liabilities. Today, it correlates with equities. It yields less than inflation, as measured by the expansion of the money supply, and it adds volatility, not stability. This isn't policy error. This is the policy. The tool the government uses to suppress real yields and real rates, response from central banks is to deleverage, to increase liquidity, to do more QE, to ease collateral terms, to rescue the market again and again. Okay, so what do I mean by easing collateral terms? Later today, the US Fed is going to vote on something called the SLR, the supplemental leverage ratio. Really fancy term, but what it means is that they're going to remove US Treasuries from the calculation that banks use on their liabilities. What does that mean? That means that the banks can now buy US Treasuries ad infinitum, as many as the US government needs to sell them, and they'll make money off of it, off the spread. It's mental. So why is this? It's because we've reached fiscal dominance, where the government spending is necessary to drive the economy. So therefore, monetary policy now exists to fund government obligations. This is no longer a cycle, it's a regime. We're in a permanent go along with the scheme. Okay, so what are we looking at here? We're looking at the growth of all the liquidity and the money supply across the world. So why do they have to repress rates in the first place? Why are real yields negative? It's because it doesn't work, the system doesn't work without more liquidity. With debt load so high, the only way out is inflation and money creation. And make no mistake, without more liquidity, the system will simply collapse on itself. And so this chart shows that global money supply growth since 2000. You could see that the acceleration in 2008, and then it goes vertical in 2020, where we're adding over 7% per year of money supply, compounded to the global supply. Remember that number. We're going to talk about it in a minute. And here we see in the US, in loop. So you have to rethink what safe even means. Which brings us to the obvious question. What do you own when everything denominated in fiat is quietly melting away? That's the question that these portfolio managers have to face every day. All right, so this is the elephant in the room. What do we do? What do we do when there's no safe asset sleeve? So this chart tracks 30 years of institutional portfolio evolution. In 1994, 85% of the capital sat in fixed income. By 2022, that number dropped to 4%. Why? Because safe no longer meant productive. Bonds don't hedge, they don't preserve wealth, they don't meet future liabilities. With negative real yields and suppressed coupons, they become an anchor that drags your returns down, not a risk buffer. And so what happens? You're forced to reach. As an investor, and I've lived this, you're forced to reach into illiquid assets, purposeful. And the job of the pension CEO isn't to chase alpha, it's to meet intergenerational liabilities through consistent, defensible process. They have to defend it themselves. They have to be able to defend it to their superiors that they're doing the right thing. And every single decision that's accountable to boards, consultants, stakeholders, and as we've even seen, politicians. And this is the capital pipeline, what a new asset must pass through to get into a portfolio. Actually, just even to be considered. So you have industry research, asset class review, due diligence, committee vetting, board approval, policy documentation, ongoing risk management. Oh, it's so difficult just to get something into a portfolio. It takes months, sometimes years even to reach a decision. Mind numbing, but why? Because of ALM, asset, because now it's policy. So institutions don't fear volatility. They price it. What they fear is being the outlier. The CIO who bought Bitcoin and got crushed in one of these drawdowns. Even if the math was solid, even if they thought they could defend it. But this is why ideas like Bitcoin take so long to break through. After all, as Keynes put it, it's better for reputation to fail conventionally than to succeed unconventionally. And so they wait, they watch. They need a bridge. And so what finally is getting them off the sidelines? You all know this. Up to last year, Bitcoin faced significant structural barriers. Really difficult to get into a portfolio for a institutional manager. You had ALM, you had committee reviews, we talked about this, fiduciary optics, and all of that kept Bitcoin outside. Well, this isn't speculative money. It's fiduciary capital that's finally been given the green light. Institutions are now learning that Bitcoin is not just digital gold. It's monetary architecture built for a world of endless mistrust, constant overreach, and oppressive inflation. It has no central issuer, no credit risk, no dilution. You all know all this. Its monetary policy is embedded in the code. Only 21 million will ever be issued, full stop. It clears 24/7. It's borderless, programmable, and it's neutral. And in a multipolar world where sovereigns are questioning the dollar system and seeking neutral reserves, Bitcoin is the first digital asset that offers true and trustless neutrality. It's simple. Bitcoin already trades over $50 billion a day. It settles in real time. It's got full public ledger transparency. I'm preaching to the choir, I know that. But then 10% just kicks it up even further. For any allocator, managing volatility or tracking error, that's not just compelling, it's portfolio engineering. It's not just about betting on Bitcoin now, it's about using it as a convex payoff in a world where traditional assets are delivering linear risk and negative real return. Many of you have seen this chart before. Jesse Myers lays it out clearly. The global investable assets are now over $1 quadrillion. And so, yeah, Bitcoin's the smallest one on there. But gold has been around for thousands of years, and Bitcoin is already a tenth of its size in just 15 years. So some quick math, if Bitcoin captures just 1% of global assets, just 1%, that's a $10 trillion valuation, or a 5x from here, without requiring retail FOMO. And the first institution to allocate, well, they're not looking for validation. They're positioning for scale. Black line is speculation. So diversification has emerged as a top reason for investing, overtaking speculation recently. So despite the common belief that speculation is the main driver, it now ranks third or fourth as the most cited reason, often coming in below client demand and diversification. So as fiduciaries, institutions are forced to ask the question, what assets survive if trust in the sovereign money continues to erode? Bitcoin doesn't need a 50% or allocation. It just needs 1% from the right players. Because when they allocate, they don't sell. They just rebalance. They normalize it. Bottom line, Bitcoin is the default escape valve, not a rebellion, a refuge. And it'll soon become the...
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.